Matthew Wolpert.
Sean Proietti.
Andrew Stevenson.
And my name is Logan Hudgens.
Okay, and judges, if you do the same.
My name is Alex Obrecht. I'm an associate professor of economics and executive director of the Eastern Economic Association. I was a high school Fed Challenge team member in high school in 1996.
Good afternoon. My name is Roy Webb. I'm a senior economist with the Federal Reserve Bank of Richmond.
Hi, I'm Stacy Tevlin. I'm the Chief of Macroeconomic Analysis here at the board. Welcome.
Thank you.
Very good. All right, now as you know, you have 20 minutes to make your presentation. I have a 2-minute card and a please finish card. So when you are ready, just give me the sign and I will start the clock. Go. Okay.
Good afternoon. We're a shadow committee gathered here today to look at the current economy and determine what we think to be the appropriate course for monetary policy. Present today are Logan, our GDP expert, Andrew, our labor market expert, I'm Sean, I'll discuss productivity, this is Matt, our expert on inflation and international exchange, and Thomas, our housing expert. And we have convened to give a statement on current economic conditions, committee expectations, and discuss our consensus over the recent development of a second round of quantitative easing, commonly dubbed QE2. At this time, we're at the beginning of a long period of slow growth with high, prolonged unemployment. And unfortunately, quantitative easing is unlikely to improve conditions much. There are also indications that the risk of deflation has increased somewhat in recent months, and we view QE2 as an important safeguard against this. But all told, a great deal of uncertainty still surrounds the recent Fed move. So let's take a look at the state of the economy for some clarity. Logan is our expert on GDP and will tell us what's been happening there.
Thank you, Sean. First, when we look at actual GDP, it's important that we also consider potential GDP. The BEA's second estimate places real GDP growth for the third quarter at 2.5%. This is right at the lower bound of our estimates of potential, which range from 2.5 to 2.8%. This graph shows the difference between actual and potential GDP, otherwise known as the output gap.
Well, wouldn't potential GDP be much higher right now due to slack in the economy? Capacity utilization is still 5 to 6% below its average.
Actually, Sean, these factors don't change potential GDP. However, they do help explain the large output gap, and they also indicate that we could afford for actual growth to exceed potential growth for some period of time. Now, final sales are also important for us to consider. As you can see here in this chart, inventory adjustment has accounted for over half of the change in real GDP in the last 5 quarters. Real final sales growth for the third quarter was only 1.2%. And this is important to remember since we cannot expect a sustained boost on growth from inventories in the future. Now, as we analyze the GDP data, we can find both strengths and weaknesses. Personal consumption, non-residential investment, and government expenditure have been the main contributors to growth in the last 2 periods. Last week's revision showed better personal consumption of goods and increased investment in equipment and software. Net exports also improved in the second revision, but have still been a drag on growth in the last 3 quarters.
That's right, Logan. The second estimate for the third quarter indicates a roughly 6% increase in exports, which was outpaced by a nearly 17% increase in imports.
Now, Thomas, residential investment began to detract from growth in the third quarter after adding some in the second.
Well, Logan, the decline in residential housing investment in the third quarter is attributable to the ending of first-time homebuyer tax credits in April. The increase in housing sales that we saw in the second quarter was probably the result of home buyers moving up the purchase of their homes in order to qualify for these same tax credits.
Now, commercial real estate is also a factor. Last week's data indicates that non-residential structures have been a drag on growth for well over a year. Now, government expenditure, the remaining component of GDP, has contributed slightly less than 1% to growth in the last 2 quarters. However, there is a great deal of uncertainty around government spending due to budget and political constraints.
Thank you, Logan. Now, Matt is our expert on inflation and will take us through recent developments and the price level.
Thank you, Sean. Inflation continues to remain below the Fed's generally preferred range of 1.6 to 2%. The 12-month seasonally adjusted headline PCEPI for October was 1.3%. Core PCEPI was 0.9%, down 0.3% from September. Core CPI fell to 0.6% in the 12 months through October. At present, inflation rates are too low to be consistent with the Fed's dual mandate of maximum employment and price stability.
Matt, I think low aggregate demand may help explain the lack of upward pressure on prices. Personal consumption, which makes up about 70% of GDP, will continue to grow slowly as households repair their balance sheets. The personal savings rate is at its highest in years, and we have seen a downward trend in consumer credit. Now, this increased savings will eventually translate into more spending. It's simply difficult to determine when.
Low labor costs are another reason for a lack of upward pressure on prices. The Employment Cost Index rose just 0.5% in the second quarter and only 0.4% in the third quarter. Although the Bureau of Labor Statistics recently announced that these figures contain errors in both wage and salary data, it is likely that corrected data will continue to reveal small increases in costs compared to pre-recession levels. Additionally, unit labor costs have declined slightly more than 2% over the last year.
And during this period, real wages have either remained stagnant or been in slight decline. Now, as shown on this graph, productivity is still posting gains slightly above its long-term trend. Preliminary estimates for the third quarter point to an increase in output per hour of 2.5% over 1 year ago. While high productivity is typical of recessions and the early stages of recoveries, it indicates that businesses are cutting costs instead of adding new workers. Investment in equipment and software is still significantly high in the third quarter, following a surge in the first half of 2010, which just illustrates that in the face of uncertain demand and price-sensitive consumers, businesses would rather pursue capital deepening to ensure productivity growth and profits. If high productivity growth and low wage growth are prolonged through the recovery, they will have the effect of contributing to a low inflation environment and hurting the already weak labor market. Now, Andrew is our labor market expert and will hopefully provide some more insight.
Thanks, Sean. The current unemployment rate is 9.6%. This is well above the Federal Reserve's target for maximum sustainable employment of 5 to 6%. The non-farm payrolls increased 151,000 jobs in the month of October. The 4-week moving average for new jobless claims has been steadily decreasing over the last month and now is below the level at which job creation should be substantial enough to accommodate new entries into the labor force. The average work week increased slightly in October, and the labor force participation rate has been relatively constant over the last year. Shown here is a graph showing those working part-time for economic reasons. The large spike would suggest that the true unemployment rate is understated. Additionally, the mean duration of unemployment is unprecedented since the Great Depression at 33.9 weeks.
Well, would this signify that there are greater than usual frictions in the labor market for people seeking new employment?
Yes, Sean. This can partially be explained by the Beveridge curve. It is a graph that plots the job openings rate compared to the overall unemployment rate. According to the Bureau of Labor Statistics, a greater mismatch between the jobs available and the unemployed in terms of skills or location would cause the curve to move outward. Given this information, the move outward would suggest a greater level of structural unemployment. We acknowledge that cyclical unemployment is still the major component. However, there is a geographic and skills mismatch which remains beyond the scope of monetary policy.
Thank you. Now, Thomas, our housing expert, will explain how the housing market has been contributing to these geographical frictions.
Well, Sean, this geographic immobility can be explained by the continued low level of housing sales and the reluctance of many households to take a loss selling a home with a mortgage underwater. Now, if we look at this graph of the Case-Shiller Index over the past 55 months, we can see that while housing prices have moderately increased for both the 10-city and 20-city composite indexes since their low point last May, housing prices remain substantially below their pre-recession highs. Even this recent moderate increase in housing prices is uneven, with half of the metropolitan areas tracked by the 20-city composite index reporting negative annual growth rates. Housing prices may have remained low due to the historically high months of existing home inventory, which was 10.5 months of supply for October. In turn, housing inventory remains high because nearly a fourth of all housing sales are showing signs of mortgage distress.
Thank you, Thomas. Now, Matt, a lot of media attention recently has been paid to the dollar's depreciation. How has this been affecting international exchange?
Well, Sean, China continues to face criticism for maintaining the yuan at artificially low levels as a means to bolster its export sector. Since June, when China agreed to allow the yuan to float more freely versus the dollar, it has appreciated less than 3%. In Tokyo, government officials are concerned with the surging yen and its negative impact on Japanese exports. In recent months, the yen has climbed to a 15-year highs versus the dollar. However, concerns over instability on the Korean Peninsula have contributed to a slight depreciation of the yen in recent weeks. The euro has been strong against the dollar for much of the year, although it has weakened recently in light of concerns over the Irish sovereign debt crisis and fears of contagion in Portugal and Spain. Despite these developments, the dollar's value against a broad basket of currencies has not changed all that significantly over the last year. As we can see on this graph, according to the nominal broad dollar index, the dollar's value is down only around 2% from a year earlier.
Thank you. Now, since we all know that monetary policy works with a lag, would you share your forecasts for the upcoming year?
Recent indicators hint at some improvements in personal consumption, while changes in investment spending, government expenditure, and net exports remains uncertain. The minutes released last week from the November FOMC meeting show the committee's projections that real GDP growth will end up between 2.4 and 2.5% for 2010, and then increase somewhat to between 3 and 3.6% for 2011.
Unemployment is projected to be over 8% until 2012. We cannot expect a swift recovery in the labor market for an extended period, due in part to the geographic and skills mismatch. Additionally, the Brookings Institute's Hamilton Project stated that even if the economy began to suddenly expand and started adding 208,000 jobs a month, the largest private payroll job increase in the last 10 years, it would take approximately 12 years to reach full employment.
Short-term inflation expectations have risen somewhat, according to the end of November University of Michigan Consumer Sentiment Survey, which reports that one-year expectations stand at 3%. Long-run expectations remain at a lower yet stable rate. The Federal Reserve of Philadelphia's survey of professional forecasters recently reported that the median projection for the average annual rate of PCE over the next 10 years is 2%. Turning towards a more market-based measure, the 10-year TIPS break-even inflation rate recently rose above 2%, indicating a slight uptick in inflation expectations.
It is expected that housing sales with some form of mortgage distress will continue to account for a quarter to a third of all transactions through 2011. Additionally, according to Rogoff and Reinhardt, severe financial recessions or depressions usually take 5.5 to 6 years before housing prices begin to recover. Now, this is consistent with the results of the Macro Markets November Home Pricing Survey, where surveyed economists all agreed that housing prices would begin to recover by 2012. However, surveyed participants were split in their opinions as to the speed of the recovery.
Thank you, gentlemen. Now, as we all know, the federal funds rate has been at the zero lower bound since December of 2008, and the balance sheet stands near a record $2.4 trillion. We can agree that the unprecedented actions of the Fed in the wake of the financial crisis were important in preventing a global financial meltdown, and that continued accommodation to date is helpful in easing along the recovery. But more recently, low aggregate demand has led to inflation rates below levels consistent with the Federal Reserve's mandate for price stability. And even with short-term rates at the zero bound and reinvestment of principal payments from agency debt and agency MBS, disinflation is causing a rise in real rates. The possibility of deflation is worrisome, and given the costs of inaction, we accept quantitative easing too in its capacity as a risk management tool. But we feel that additional quantitative easing is going to carry significant costs that likely will outweigh the benefits. Increasing the money supply is unlikely to alleviate such varied, troublesome economic conditions as we see today. Framing our discussion this afternoon is a recent speech by Dennis Lockhart, president of the Atlanta Fed, wherein he describes the 3 transmission channels through which QE2 will supposedly ease troubled markets. And we will use these 3 channels to show that QE2 will be ineffective on growth. The first channel is the credit channel, where individuals and firms are provided with needed liquidity. William Dudley of the New York Fed estimates that interest rates across the board could fall by as much as 50 to 75 basis points with a $500 billion Fed purchase of long-term debt.
Sean, I'm doubtful the effect will be that substantial, given that a staff report from the Federal Reserve Bank of New York showed that a $1.725 trillion purchase of securities, more than 3 times that amount, had the effect of reducing the 10-year term premium by only 38 to 82 basis points.
Well, either way, we would expect that lower rates would make borrowing more attractive and therefore stimulate consumption and investment spending. The problem is we are already experiencing extremely low rates, and consumer and commercial loans are still on the decline. Some would consider this position a liquidity trap. Larger firms that can qualify for lending already have plenty of cash on their balance sheets, while banks are reluctant to lend to smaller firms who really need the funding. Also, a Fed model predicts that $500 billion in Treasury purchases will only increase real GDP by 0.2%. In order to bring actual growth far enough above its potential to really help the employment situation, the Fed would have to consider extremely large Treasury purchases.
Well, Logan, I'm unconvinced QE2 will translate through the credit channel into large benefits for housing. Banks are already finding their profit margins squeezed by historically low mortgage rates and are likely going to resist cutting rates any further. Furthermore, even if we do assume that rates fell further, it's unclear how this would lead to a substantial increase in housing sales, as the number of consumers interested in purchasing homes at existing rates don't meet banks' stringent credit requirements.
Another possible consequence of the credit channel is that it could raise inflation to levels higher than intended.
The second channel is called portfolio balancing, as investors turn from low-yield government debt to corporate bonds and equities, creating a wealth effect and stimulating consumption spending. The increased activity in corporate bond markets would also provide firms with liquidity needed to take on investment projects, and investment should also be stimulated.
One risk is that instead of moving into equity markets, investors may turn towards speculation in commodities, possibly fueling an asset bubble. Prices of gold and silver have recently risen to record highs as investors seek real assets as a more reliable store of value than cash. In light of this, the portfolio balance channel could prove to be both ineffective and risky.
Another risk, Matt, is that bond investors may look towards emerging markets in order to find better returns. This would have the effect of increasing domestic bond rates, which is exactly the opposite of the intentions of QE2.
The third and last channel is that QE2 will likely depreciate the dollar in currency exchange markets and thereby boost net exports.
Empirical data indicates the presence of a significant lag between the lowering of exchange rates and any associated increase in net exports. Represented by the J-curve, this lag can last up to 2 or 3 years, so we should not expect any near-term boost to GDP. In terms of scale, net exports have historically contributed a fairly small component of GDP, so any increase is unlikely to contribute greatly to an economic turnaround. Additionally, a weaker dollar has implications for import prices. In the 12 months to October, import prices rose 3.6%. This imposes a burden upon domestic firms which rely upon foreign inputs to produce their goods.
And QE2 also faces significant obstacles in other, less quantifiable areas such as uncertainty, the expiring Bush tax cuts, fiscal uncertainty, healthcare reform, financial regulation, and a number of freshman lawmakers entering Congress, all create an environment where individuals and firms cannot even be certain about what the near future will bring, and growth is stymied because businesses are afraid to expand.
Employers have indicated an unwillingness to expand payrolls, in part due to these uncertainties regarding these new regulations, as well as potential healthcare costs. This is not a matter that can be resolved with monetary policy, thus limiting the potential impact of quantitative easing too.
Credibility also remains a serious concern. The prospect of higher than intended levels of inflation as a result of quantitative easing could serve to unanchor long-run inflation expectations,
which would completely detract from all the gains the Fed has made in the past 30 years. The Fed is moving in uncharted waters. The inherent difficulty in unwinding a balance sheet projected at nearly $3 trillion creates further risks to credibility when the time inevitably comes to end accommodation, and using short-term easing thus endangers long-term stability.
Yes, Sean, I'm concerned the Fed may have to begin unwinding the balance sheet before any real improvements have been made to employment or growth. Tightening policy could be very damaging in this situation.
And it's true that QE would guard against deflation, but it has unfortunately been advertised to the public as a tool to lower unemployment and stimulate GDP growth, and public confidence in the Fed will be undermined if it doesn't work that way and growth remains sluggish, which is likely. But sluggish growth is still growth. We're seeing that many of the economy's problems are beyond the scope of monetary policy. And while enacting QE2 may help avoid worse problems like a deflationary spiral, we feel it should only continue with the provision that inflation be closely monitored. If inflation expectations become unanchored, or if leading indicators such as unit labor costs or core producer prices increase more quickly than is desirable, quantitative easing must end. The muted benefits of this policy action cannot be allowed to risk hard-won price stability. The tools of the economy to repair itself are all in place, and further intervention by policymakers may only prolong the painful healing process. Thank you for your attention, and we'd be happy to take questions now.
Well, thank you for for that presentation. You covered a lot of territory. You've obviously worked hard, and we especially appreciate this coming at the end of the semester when so much is going on for you. Let me go back to inflation expectations. You mentioned the survey of professional forecasters, and you mentioned tip spread. Are those the only measures we have for inflation expectations?
Well, we also, the survey of professional forecasters, the University of Michigan survey, the tip spread between nominal and inflation-protected securities. Mm-hmm. Those are some of the primary measures.
So what's the University of Michigan survey showing lately?
Well, as I mentioned, they're showing that short-term inflation expectations are standing at around 3% for 1 year. They're slightly lower for the long term.
Should we be concerned by that?
Well, it's actually good news that inflation expectations have risen somewhat because that has the effect of lowering the real interest rate.
I think we also have to remember that a big part on the consumer, they see gas prices going up and food prices going up. So from the consumer that is being surveyed, a lot of those increases may be not necessarily included in core indexes.
And also with increase in consumer expectations for inflation, it might alter their behavior and possibly get them to spend more, which is exactly what would not happen in a deflationary spiral where they would withhold their purchases.
Okay, thank you.
So this has been a pretty interesting time to be studying the Fed, I assume, with all the scrutiny it's been getting. One thing that's been in the press a little bit, and I'd like to get your opinion on, is there have been some calls for a return to the gold standard. And what do you think of the pros and cons of that, and is there any merit in that suggestion?
One of the problems with the gold standard is that tying to such a fixed, constrained monetary policy, in effect, changes in the supply of or price of gold replace monetary policy. You might just see large quantities of gold being unloaded into the market, and you'll have an expansionary policy, maybe not when you want it.
It's just at this stage with the interconnectedness of the global economy and the scale of the economy, it's just simply unrealistic.
Thank you. So you went through a list of reasons that you were against QE2, and but one thing I was having trouble putting together. So you mentioned things like the effect, it's too small to have any real effect, or that there are structural issues in the markets themselves that are going to make it ineffective. But then you also mentioned that it might have an effect on raising inflation. And I was wondering, if it's going to have no effect on the real economy, what's the channel through which you think it might have an effect on inflation?
Likely portfolio balancing is what we've been seeing, especially with the almost rapid increase in equity prices since the Jackson Hole speech. And although it's impossible to prove they're correlated, the subsequent increase in consumer spending is definitely good news. And like we mentioned in the presentation, an increase in equity prices would increase consumer wealth and stimulate consumption spending.
I think on that note, it's important to consider the increase in the wealth effect that would be needed to really bring us anywhere near full employment would be so massive that it's if you do the calculations, it's over hundreds of trillions of dollars.
Untenable.
So, yeah.
But then how does it get into inflation?
Well, I think the main thing is inflation expectations.
The more consumers are spending, the more they would keep those prices from sinking.
Thank you.
You talked a little bit about structural unemployment, and you said the beverage curve gives you a little bit of a hint at that. Is there any other data you could look at that would tell you how much structural unemployment you might have in the economy? Or a different way of looking at the data?
I'm not sure what you're getting at.
You listed like other indicators we could use.
Is there anything else in the labor surveys you could look at that might give you a hint that structural unemployment does exist?
There's the number of people seeking each job, and that's actually decreased recently, but the unemployment rate hasn't decreased to the same level. So it appears that more jobs are being offered, but the unemployment rate's staying the same.
Also, possibly figures which represent the percentage of people who have been unemployed for an excessively long period of time.
which may eventually turn into structural unemployment as their skills erode.
In turn, the productivity gains that we've seen in many firms, if this means that when the economy picks up, they may not need to hire as many workers in the long term, and so people may find themselves skill sets that no longer meet the market's exact needs.
Let me twist a little bit to a softball question for you. Being an educator, I'm always curious to know, what do you think is the most important thing you've learned by participating in the Fed Challenge?
I think there's so much, especially with everything that's going on right now. It's a lot to learn. I mean, I think we've learned not just strictly with what we've learned about monetary policy, how monetary policy affects the economy, and what indicators are used. I think personally, I feel at least we've learned how to work as a team, and I think there's other factors that we've learned outside of strictly just learning about the Federal Reserve and how it works and how it affects monetary policy.
And also just getting beyond the models that we learn in early macroeconomic studies and seeing how they're actually applied in real life. And also the ability to draw your own conclusions draw your own rational conclusions from what you've been reading and what you've been seeing in the economy, which doesn't necessarily factor into a lot of other courses or areas of study.
I think for me, reading, just following all these speeches and seeing in many ways the public's reaction to the forward guidance and to some of the statements made by members of the FOMC just underlines how much people really look at what they're saying, and even in other countries you often see what do they say, what do they release after the minutes, what are their policy doings, and so in many ways what we say is very important to the overall economy and looked at closely.
A final thought, I would also add that the experience of keeping track of data, which is constantly changing, analyzing the economy, it's obviously a moving target, and getting the practice to look at new data when it comes out, incorporate it into our presentation, writing it, rewriting it, editing it, has been an experience that I haven't had in any other courses that I've taken, and I think it's a positive one.
Presentation skills have also had to improve greatly.
Speaking of the minutes, I'm kind of a nerd, and I was looking at the minutes, and it says, in a joint meeting between the Board of Governors and the FOMC. That's what we've seen in the minutes now since about March 2009. Before that, it was just always in a meeting of the FOMC. So they changed the beginning of the minutes. Any idea why that might be the case? I mean, I don't know the answer, but I'm hoping you might be able to fix my nerdiness in this.
Greater transparency. I'm not really sure. An attempt to get a greater array of voices in the policy discussion.
There have recently been a couple of other changes in the way they do the structure. If we look at, I think, which Fed from each bank, which people can be nominated, is also different. I think they didn't want bankers to be able to sit on the FOMC.
Bankers aren't really able to vote.
Let me change gears one more time, and you mentioned the implicit preference of FOMC members for inflation of 1.6 to 2% early on. Do you think that's a good number? Is that really optimal, or should it be something lower or something higher?
Well, we would definitely not advocate that it be any lower because of the downside risk of deflation, and it's the horrible consequences that would be attendant with that.
The reason it's in the 1.6 to 2% range is simply to provide a buffer against deflation.
Okay, with short-term inflation expectations at 3%, do you think we need to be worried about deflation right now?
I think we've seen a downward trend in inflation over the last couple of months.
I mean,
Also, like we mentioned earlier, sometimes inflation expectations are based around things in the headline, PCE and CPI, such as food and energy prices. And also, the risk of deflation is considered when we think about the possibility of further negative shocks. In the absence of policy, we might be okay if things started picking up and the economy decided to grow again. But further negative shocks always provide a risk that might tip us over into deflation, considering the very low level of inflation that we're seeing right now.
I think to add to that, I don't think any of us really have a strong opinion that there's a high risk of deflation. It's simply that the implications of deflation are so risky or so terrible that we want to provide that buffer just to be on the safe side. Because if we did end up in a deflationary spiral, it's so bad. So
A recent visceral example might be Japan during the past 2 decades, where it's in many cases regarded as being near the zero bounds and just being stuck in a rut for a very long period of time.
You had mentioned that the recent indicators of consumption have been more encouraging. I think that was you.
Yeah.
Can you tell me what those indicators are and
Yeah,
what your outlook is for PCE?
retail sales for October came out a little bit better than expected. There has been a little bit of durable goods was down somewhat. Let's see, what's the other? There was. Do I have any help? I know production was up, I think 0.5% in October as well. So I know that was another one that would kind of be a leading indicator for consumption. Those were the main figures I've seen recently that hint towards some improvements in consumption.
Thank you. Well,
I guess
also more recently, reports from Friday and yesterday are looking good for holiday spending. So.
And actually, to add to that, corporate profits came out much better than expected, which could in turn expand on the wealth effect. So could have some implications on consumption.
The Fed right now is paying interest on excess reserves, right? And so that should essentially set a floor for the Fed funds rate. But we're still seeing the Fed funds rate trade below that floor. Any idea why we might be observing that?
That's because non-banks such as money market mutual funds don't qualify to receive interest on their excess reserves. And although it was originally thought that the interest on reserves would serve as a floor, these banks are willing to trade below that amount in order to take advantage of the federal funds market.
Okay, suppose the economy is recovering rapidly next year and inflation's picking up a little bit and you decide the Fed needs to start to reverse its policy stance. Does it matter in what order they do things? Do they need to contract their balance sheet before they raise interest rates?
I don't think we would advocate contracting the balance sheet because any selling of securities is going to amount to a tightening of monetary policy. I think our consensus has generally been that raising the interest rate on reserves first would serve as a better guard, especially due to the amount of liquidity that's in the system right now. And the fact that, we have the issue of pushing on a string with quantitative easing, and it could very easily be turned around to pulling on a string, like how much is enough. Because even though we have these tools, they've been tested on a small scale, nobody's exactly sure how the entire exit is going to work.
I think Bernanke himself in a speech in February and also in his recent speech on the 19th on Friday, he's indicated that he would likely move with adjusting interest on reserves first because it would likely be the quickest way to contract monetary policy somewhat, and also because there is so much excess reserves in the banks, the federal funds rate, there's not nearly as, or there's so much liquidity by trying to target the Fed funds rate, the banks don't really need to lend to each other as much. So interest on reserves would be a much better way to control rates.
Also, with all the attention that's being paid to forward guidance, it might be worthwhile to remove the statement that the Fed will keep the federal funds rate at low rate for the foreseeable future or at accommodative levels.
Thank you very much. Thank you.